Jerome Powell has opened the door for a potential rate cut in September, but with more signs of sticky inflation, will the Fed actually deliver on lower rates? Joining us now to discuss is Chris Whelan, head of tactical trading strategy for global fixed income at TD Securities. Great to have you back in the program, Chris.
Yeah, thanks for having me back.
So we've had the big speech that we were waiting for all summer,
Yes.
Jackson Hole, Wyoming, the convergence of the central bankers. Jerome Powell opens the door to a rate cut.
Yep.
Even he had to recognize that they haven't won the battle against inflation. What can we expect of the central bank?
Well, I think what was the notable shift from Jackson Hole was that they started emphasizing downside risks. And I think that the inflation data hasn't come in as much as they feared, as high as they feared on the tariff side. And I think if tariffs weren't part of the equation, we probably would have seen a much more modest inflation profile already, and they probably would have already been cutting more than they have so far. So I think the notable shift from Jackson Hole is emphasizing downside risks, and I think the reality is that the inflation is coming in, I think, less than feared, and so I think that's opening up the ability to see another 25 basis point, like 25 basis point cuts by the end of the year. I think that's pretty reasonable.
I was going to ask you if they get started again in September, they don't. It would be strange to have a one and done. Like, what would you be telling the market if you just cut once?
I think whenever we look back historically at central banks and we look at when they cut, usually once moves of just one 25-point move at a time is pretty rare. So I think to assume that they go twice. Twice or potentially more, but I think the balance the market's kind of pricing in two. I think that makes sense, like closer to two. So I think the market has it about right. I think that makes sense.
What scenario would we be in that potentially more? We get two or potentially more. What does the central bank need to see?
I think you need to see a notable deterioration in the data. So I think you're gonna need to see that pretty broad. You're gonna want to see that on the labor side, on GDP side, on the retail sales, on your ISMs, and I think you're gonna want to see that broadly across the board, and that would probably have to happen notably quick for that to start talking about 4 rate cuts or something like that within this calendar year. So I think it'd be a notable deterioration in the data. I think that's pretty hard to predict. I don't think that's not the base cases that we have at TD Securities, but I think that's what it would take, a notable rolling over broadly across the board, which we're not at right now.
We're about 3 weeks away from that decision. The market is figuring a 25 basis point cut. You're saying that was the House view as well. To go 50 now that they're restarting it, what would it take for them to do a 50, to go big size? Didn't they do that about last year at this time?
Yes, I think to go 50. I think given how nervous they've been and how much they've paused, I'd be surprised for them to just shift to a 50 without something notable happening. The 50 discussion is a reasonable discussion because we've been having that kind of discussion at work on the client side. I think the markets kind of flirted with pricing that in. For us, I think that just seems a bit punchy to expect, given how hesitant they were and that we're just starting to kind of warm up. It seems like the Fed is just starting to warm up to cutting again. So I think 50 feels just a bit too bold. But again, it's just, you'd have to see a notable deterioration in the data, basically rapidly. And I'm not sure you're going to have enough of a data picture built within the next 3 weeks for that to happen.
That's September 17th. It's going to be that Fed decision. It is a rare. We've had a couple of them this year, and they're sort of rare double headers where we get the Bank of Canada in the morning, the Fed in the afternoon. So the Bank of Canada is going to be the 17th as well. What are our expectations there?
I think on the Bank of Canada side, we can see them cutting twice, another 25 basis points 2 times, so 0.5% by the end of the year. Whether that's kind of September or not, what made that, I think September was looking pretty decent for a 25 basis point cut, except we had retail sales data come in pretty strong last week. That kind of makes things a little bit uncomfortable for the September move. So we'll kind of see how the data kind of comes in over the next 2 or 3 weeks. I would say that September is not an easy call to make, but I think we feel much better when we say, hey, by the end of the year, or kind of by January, February-ish, we're going to be about half a percent lower than we are now.
The Bank of Canada has a struggle with the tariff story, just like the U.S. central bank does. Bit of a different situation for us trying to figure out how hard is certain segments of our economy. Obviously, if you're aluminum, steel industry, if you're in autos, getting hit hard. But overall, a lot of exemptions because of the USMCA. Does that make it hard for the Bank of Canada to try to figure out? We've been trying to calculate the damage. We're hearing perhaps the damage isn't as widespread as we should fear. Can we say all clear?
I think, well, first off, we don't even know what kind of deal could come out of left field or not come out of left field in the next while, or kind of what the impacts are there. But I would say, yeah, it's been fairly orderly. Like USMCA covered a lot of items, and I think there was paperwork and making sure that your items were covered and that they weren't getting tariffed, and there's kind of some supply chain hiccups and some kind of uncertainty, and there's a bit of hiccup in the business cycle where you kind of have businesses and consumers maybe holding off because of tariffs, and then all of a sudden that's pushed forward, and that just really makes the central banker's job really hard. And kind of when consumer behavior is getting volatile, while you have pricing volatility as well. So I think it's a super difficult backdrop within all of that. I think that being said, when we just take a step back and we look at the inflation profiles and look at what the inflation our macro team has been modeling, they look fairly well behaved into the fall. So I think where we are going to be with inflation sets up the Bank of Canada to kind of have that confidence to start cutting. Growth has been pretty modest. The retail sales data, that's not a data point I want to put a ton of emphasis on, but I think that aside, the growth has been weak. The inflation profiles are moderating, sets it up for the Bank of Canada to lower the overnight rate by 0.5%. So we should see that if it's not by the end of the year, then into the early part of the winter.